Options are contracts. They give you the right to buy or sell something at a set price. This right has a time limit. Stocks are different. Stocks mean you own a piece of a company. Options are about betting on a price move. Think of it like a coupon. You have a coupon to buy milk for $3. If milk goes up to $5, your coupon is valuable. You're buying at a discount. If milk drops to $2, your coupon isn't as useful. You wouldn't use it. Options are similar. You're betting on whether a stock will go up or down, but you're not obligated to buy or sell if you don't want to. That's the beauty of options. This flexibility makes options powerful, but it also means they can be risky. You need to understand how they work before you start trading. That's what we're here for. There are two main types of options, calls and puts. Calls are like betting on a stock to go up. Puts are like betting on a stock to go down. Imagine you have a call option on Apple stock. The strike price is $150. If Apple goes to $170, your option is in the money. You can buy Apple at $150 and immediately sell it for $170, making a profit. Now, imagine you have a put option on Tesla with a strike price of $250. Tesla drops to $200. Your put option is now in the money. You can buy Tesla at $200 in the market and use your option to sell it for $250, making a profit. Options can be confusing at first, but once you understand calls and puts, you're well on your way to mastering options trading. Before you start trading options, there are a few key concepts to understand. Contract size. Options contracts usually represent 100 shares of the underlying stock, so if an option contract is priced at $2, it will cost you $200 to buy. Expiration date. Options have an expiration date. After this date, they become worthless. Moneyness. This refers to whether an option is in the money, out of the money, or at the money. Intrinsic and extrinsic value. Intrinsic value is the profit you'd make if you exercise the option today. Extrinsic value is the time remaining until expiration. Understanding these concepts will help you make informed trading decisions. Let's walk through an example of executing an options trade. Say you believe that Amazon stock, AMZN, will rise in the next month. You could buy a call option with a strike price slightly above the current stock price. If AMZN goes up as you predict, your option will increase in value and you can sell it for a profit. Remember to consider factors like the contract size, expiration date, and your risk tolerance. Options trading involves risk, and you could lose your entire investment. This is just a basic example. There are many different options trading strategies, each with its own level of complexity and risk. Always do your research and understand the risks before making any trades.